All right, guys, good evening. It is Monday, the 4th of March, and it's 9 p.m. here in Dubai, and you're with me, Clemens, and it is our first class where we focus on the campus indicators, and today we'll kick off this new series by looking at the seasonality indicator, right? And then tomorrow evening, we will look at valuation. And then next week, Monday, we do the COT. And next week, Tuesday, we will then the strategy optimizer. And then we rinse and repeat, right? So basically bi-weekly, we have then a seasonality and evaluation session. And these sessions are obviously primarily addressed to you and for you. So I do encourage that you join and bring questions on into this class because we have a lot of new students here, and we do realize that the indicators might be a bit complex and overwhelming. So we just wanted to dedicate a session for every single indicator, right? So I encourage you to join, make the most out of it, and ask questions. We see how it goes, right? Maybe we shift timings later on or days. Again, it depends also a bit on your feedback. So what I want to do today is I just want to go very briefly touch on seasonality as an indicator, what it can and what it can't do, dive into a chart, play around with it a little bit, and then really open the floor up to you and whatever questions you may have, right? So this classes are not supposed to replace the blueprint course, right? This is still your job to obviously do self-paced learning, watch the blueprint course that covers the indicator, rewatch it if you have if you feel that there is something that you're not 100% clear. And then ideally you would have also covered the futures lesson by now, so that you have the fundamental basis in place in terms of knowledge. And then you come into this session to ask questions or to kind of like get additional information on it. Yeah? So when we look at what we teach at OTC, we basically have two things, right? We cover technical analysis and fundamental analysis, and they both work very well together, and they don't really work very well in isolation, because each of them is like a tool which has a very good application for one thing, but might have a disadvantage when you try to apply it for something else. So you can think of it kind of like your toolbox, right? And you have a hammer and a screwdriver, and both of them are very good tools, right? And they can build you furniture if you combine them. But a hammer is not very good on screws, and a screwdriver is not really good on nails, right? So I'm just looking at the chat. DevGun 9950. So blueprint future OTC a must watch. The blueprint, ideally, yes, because otherwise you might find it very difficult to follow what we're doing here. Yeah. I would always start with the blueprint before you join any live classes, just to make sure that you understand the basics of supply and demand, that you have seen a chart before, and that you understand if we highlight a zone, why we might highlight it. Okay, so going back to what we teach here, like I said, we have technical analysis, fundamental analysis, and both of their advantages and disadvantages. So we obviously use supply and demand as the core for everything. And it's very good in timing the market, right? But it's not necessarily very good in looking into the future, because just because we point out a zone on a chart doesn't really mean that, first of all, price is going to respect that zone, right? So that the zone, let's say we place a demand, we draw a demand zone on a chart, that this demand zone will actually hold. And if it holds, we also don't really have an idea of how long price will then continue to move in our favor, right? We might just get a bounce out of it and then get stopped out, or we might have a crazy rally from it. And just by the zone itself, it's very difficult to kind of understand that and looking into the future. So with a fundamental analysis and with our indicators, they're very good in forecasting. So in terms of they give us an idea of what will most likely happen, but they're very bad in, or not very bad, but their disadvantage is it's difficult with them to time the market. Yeah. So they might tell us that we have a high probability that there will be a rally from tomorrow onwards, let's say. But what it doesn't tell us at what price point this rally then starts, right? And this is where we then would rely on supply and demand, so our technical analysis to identify a demand zone, in this example, that is of high quality, where we then believe that price would turn and build up a new trend, right? And this is why they're very powerful when you put them together, and they work, but not very well if you leave them in isolation. So if we take an analogy of an iceberg, right, basically what you see is price on a chart at the end of the day, right? That's all you see on the chart. It's price that is then converted into a red or green candle. The problem is that price itself doesn't drive itself. So what that means is that price doesn't decide if now a stock or a futures goes up or down, right? That move is always driven by the underlying fundamental conditions. And this is what we don't necessarily see on the chart, because the chart just tells us in real time what the current price is and what it has been in the past, but it doesn't tell us anything about the underlying fundamentals that cause price to go into the direction that it is going right now. So like I said earlier, we use supply and demand for location or direction, right? And for trend, but we also use it to time the market. But then we can put our indicators to use in terms of the CT, the valuation, and true seasonality to then understand more what drives price and what is most likely to happen next. And true seasonality is what I will focus on in today's session. The good thing about true seasonality is that it works very well on all markets, whereas, for example, valuation is more of importance or relevance in infinite markets, whereas the COT is more of relevance in finite markets. So while you can use them on everything, the indicators tend to work better on one type of market over the other. However, with true seasonality, it applies well to all type of markets, right? And if you think about that a little bit, it kind of makes sense, because in life, basically everything is somewhat seasonal, right? Your life itself is seasonal, right? You're born, go to school, you go to college, you marry, you have kids, and then one day you die. So everyone has kind of like more or less the same season that they go through in life. The weather goes through seasons, unless you live in Dubai, but everywhere else in the world, you usually have 3 to 4 seasons. And so because everything around us in our lives itself is driven by seasons and seasonality, of course, that then also reflects in the market, right? Because at the end of the day, the markets are just a reflection of our of supply and demand, and that is heavily driven by seasons. The tricky part, obviously, with seasons is that they change over, or they can change over time, right? So, and that's why when we look at seasonality, we usually say we focus on 5, 10, 15 years, right? Because what was hot 50 or 30 years ago in the market, in terms of what was the latest craze back then and what might have driven the market, is no longer relevant today. So the seasonality also can change over time. And then you have bigger events, for example, something like the COVID crash that heavily impacts seasonality, but they are one-off events, right? So we also have to be a bit careful when we look at seasonality to not take too many years into context, because then you might get something that is no longer relevant for us. It's same again if we look at the weather, right? It used to be, at least where I come from in Germany, that we had white Christmas, that it always snowed on Christmas. And for the past, I don't know, 15 years, that hasn't really happened anymore, right? It just shifted. Now it usually snows in, I don't know, Jan or Feb, and no longer in December. So if I would take too much weather data into my seasonality, it might tell me that there's a very high likelihood of snow in December, but that's kind of outdated by now. Yeah. Okay, then let's have a look at the chart. Maybe for my understanding, have the guys that are here in the, so we have 12 people here in the room so far. Do all of you have the indicators, and do you all have them up and running? If you could just let me know in the chat. Yes, 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 not yet. Yes. Have them, not yet. Okay. So mixed. Yeah. I would say the majority have them, which is good. Okay, so then let's do a very basic overview of the true seasonality and how it would look like on the chart. So what you see here is a futures chart of the 30-year treasury bonds. It's a daily chart. You have that here on the top. And then on the bottom, I already have the seasonality indicator running. So that's the red line. And it's currently set up to 15 years. So it takes an average of the past 15 years and plots them down here. What is very important to understand about this indicator is, first of all, like I said in the very beginning, it's not a timing tool, right? So let's do an example. So right now, over here, right? So right now, market should, it's a little bit bigger, sorry. So right now, the seasonality says, right, we are in the downward projection. That doesn't necessarily mean that it then always happens, right? There's a high probability that we will see red candles until the 6th of March. However, there are, and you will see this later on when we do some backtesting, there are instances where the indicator is off, right? Because nothing always works 100%. And like I said, things change. And sometimes there are other fundamental drivers in the market that kind of then overrule seasonality and push price higher, even though it's supposed to go lower historically. Yeah. So an example could be, for example, if we look at a very seasonal market, like let's say wheat, right? Like something that is harvested. And from a seasonal point of view, I don't know, I'm just making stuff up now. In March, it always went up because it's when they price usually went up because it's when they started harvesting. However, that year it was like an extremely great year in terms of lots of rain and good sun, etc. So the crops were there was like a really big harvest, then price might go down because there's just so much supply that this kind of overrules it, right? Because the farmers were able to harvest a lot more than anticipated. So that's why I said it's not a timing tool. So we wouldn't now just blindly go short because we say, hey, you know what, it's going to drop until the 6th of March. It's something that gives you an indication, right? Same that if you go back to the analogy of the weather, that you know that on average in December, it's usually quite cold. So that means if you're waking up in the morning and you're like, what should I wear? A sweater is probably going to be a good idea rather than shorts and t-shirt. However, that is not to say that there are days in December where it's actually pretty warm, right? And the sun is shining and there's no wind, and you might be overdressed if you wear a sweater. Yeah, so it just gives you kind of like a guideline and a general understanding of where things move. The other thing that you have to keep in mind of with the indicator is that the line and the steepness of the incline or decline does not or cannot be interpreted as the corresponding steepness in incline or decline in price. So just because you have, let's take an example here, you went from here to here, which is, let's say, fairly steep, doesn't necessarily mean that price then, I mean, here it did actually, right, goes down fairly steep. So it just tells you that there is a high likelihood of price from the end of Jan to the end of Feb that price will decline, but it doesn't really tell you how strong it will decline and how far it will decline, right? So it just gives you an indication that it should decline, but keep in mind that a candle like, just looking here at the chart, this candle here, for example, these two candles, right? They're both red candles. So price declined over here. But we can all agree that this is not a significant or strong decline, right? So if you look at seasonality here, seasonality said it's going to drop, and price did drop, but actually price kind of went sideways or even up in the grand scheme of things. But it is a red candle, so price actually did go down compared to where it was before, right? So I hope that makes sense, is that it doesn't really tell you about the strength of the move that we anticipate. Again, if I would reference it to the weather, you know that December is going to be cold, but you don't really know how cold, right? Does that make sense so far? Are you able to follow? Yes, all clear? Okay, great. Now, seasonality, again, is different for every single market, right? And this is kind of then your job to do a little bit of back testing. Where does it work well? Where does it might not work so well? And what are the correct settings? So for example, if we would do that together, let's start with 5 years, right? So very short-term seasonality. And what we can then do is we just look here at the indicator and look for extremes and put a horizontal line on, a vertical line on it, and then see how accurate it matches what price and does on the chart. And if we see that there's a big discrepancy, we can then say, okay, let's try maybe for treasury bonds, maybe a 10-year seasonality works better. And we would then look at 10-year. And if we still have a lot of discrepancies, you can say, hey, let's try 15 years. Maybe for treasury bonds, 15 years works best, right? And then you write that in your trade plan, and then you go to the next asset class and you look at, I don't know, oil, right? And you would do the same thing for oil. And over time, you will see and you will learn what works best for which market, because a 5-year seasonality might work very well on gold, but maybe a 10-year one works better on wheat, yeah, just as an example. So if you want to backtest it, literally the easiest way is you take the indicator and you just look at extremes. So let's say we have a bottom here, right? And we have a top here. And then you literally look at, okay, did price price went, price went lower, right? And it did the same in the chart. So that's pretty accurate, right? And then you keep going. You take, okay, there's a low here, there's a high here, so price should have went up. And actually it went down and then up, but overall, right, price increased. However, it had this dip. Yeah, so not ideal, but at the end of the day, price from this point until here, price did increase, and that's what the indicator told you what would happen. And this is where you kind of see what I mentioned a couple of minutes ago, is where you cannot read into this indicator the strength of the move. Yeah, because you saw that, yes, price actually from left to right went higher, but it first went lower and had this drop in it, right? Which is, it's also reflected actually here, right? Price went higher and dropped, but again, it doesn't tell you how strong and how far it would drop, right? This is then where supply and demand, for example, comes in, because we can already see there is a demand zone here. So if we say, okay, price is gonna rally and then drop a little bit and then rally, then there's a high probability that this demand zone will be the cause of price rallying again. So let me just quickly go over the questions. What do you think about using two seasonal charts like 5 and 10 for some more confirmations? Yeah, Louis, you can do that. Of course, you can just add the indicator again, and you can put 5, 15, you could put as many as you want on it. It's up to you what you prefer. Approve 5, 10, 15 and come to a probability of what percentage that day it worked. It was somewhere in the blueprint. Yes, exactly. You can calculate that. Yeah. Okay, so let's continue. Let me just get rid of these lines. So we would continue moving. Okay, we have an extreme here and a low here, and we would look at the chart and say, okay, price was supposed to go down, right? Here price actually went up and down. So here it didn't really work that well, right? Then we look at the other extreme. There was a low to the top here. So price did this, and the indicator said it was supposed to be doing this. Okay, that's pretty good. We can go back here, right? There is a kind of like a spike here. Price then should go down with a small bounce in the middle or towards the end. And that's exactly what price did. But see again here, if I make this bigger, let me get rid of this line. The indicator did say that there will be a bounce, right? Small spike. Again, it doesn't really tell you how much and how far this will bounce. So you see that the 5-year one is fairly accurate so far, right? And like I said, you can then change it to, sorry, you can change it to 10 years, and you can literally do the same thing. And you can see then, okay, is 10 years more accurate than the 5 one for the US Treasuries, and so on and so forth, right? And you can do that for the marks that you trade. And over time, you will kind of get your own system of what works best for you and which setting you want to use. Yeah, I would just avoid really having more than 30 years, to be honest, because then you probably get a lot of outdated kind of seasonality into the data. And it doesn't really then, it probably then becomes more and more inaccurate. Morty, can you show us a sample with comparing the 5, 10, 15, like the seasonality chart on the daily grid? You mean have all of them here at the same time? Yeah. Okay, so let me just get rid of the lines here. So right now I have 10, so let me change this to 5. And then all you would do is you would right click anywhere on the white, and you would add the study again. So you would go again to true seasonality. I don't have a lot of data on the right, so I just don't project 100. I just project 30 days in the future. For me, that's enough. And I want to have 10, right? And then you would have the 10. And you could add another one now if you want, that then has the 15. And then you would have all of them together. And then you can actually do the analysis that we just did, because the vertical line runs through. You can do it simultaneously across all three of them. Yeah, what you can also do is, if you prefer from a visual point of view, what you can also do is you can left click and hold, yeah, and then drag it into the chart. And then you just have to display it, sorry. You have to put it on the other axis. So we want to have it on the left axis. Yeah, here we go. And then you kind of, let me just deactivate the other one. Yeah, then you have it inside of the chart, right? So if you prefer this, you can also do it. Then if you move on the right here with your mouse, you change the size of the candles, and on the left of the seasonality. And this kind of overlays it then, right? If you find it difficult to read, what you can do is, for example, what I do, I just change the color and I give it like a light gray. So it doesn't hurt your eyes too much. It doesn't hide kind of candles. So you can kind of fade it out. And then again, you can play around with it and see what works best in terms of accuracy here, right? Because you overlay it. So you then say, okay, if you double click on it then, and say, okay, let's go back to 5, right? And you can see, okay, how accurate is it here with the 5? You can see it's pretty accurate, right? You can already see if you just like follow the candles kind of as if you would draw them with a pen, you get fairly accurate, the same kind of drawing that the indicator line does. Yeah. Does that make sense? Okay, good. So kind of to summarize a little bit, again, it's a tool, and this is why we need space to the right. You can see that price doesn't do any forecasting because price only works from right now into the history, so towards left, but it doesn't project anything into the future. And right now, we have no way of telling if price is going to go up, down, or sideways, right? You can see that indicator goes into the future because it's already here. This is already in the future. It's the 14th of March. So it tells us that there is based on historic performance, there is a high probability that price will continue to rally until at least the 11th, if not the 14th of March. But what it doesn't tell us is two things. First of all, is it how strong is it going to rally? So is it going to go all the way up to here, or is it maybe just doing this kind of thing, right? Because that would still be a rally because it's higher to what it was today. So first of all, it doesn't tell us that, right? And it also doesn't tell us where it then reverses. Yeah. So for that, we would then have to look obviously at supply and demand. So we would have to kind of identify supply zones. For example, there is one here, right? There is another one here that has been tested. There is another one here, right? And we would then also have to look at the other indicators. And after these sessions, you can then put them all together. And we will do that also at some point. And then you really get like a holistic picture of your chart. And it will be much easier for you to make a decision. This is the seasonal indicator. There's also, let's say, seasonal cycles, which are not baked into the indicator, but these are also things that you should be aware of. So one of them is, for example, what Byrne shows in his weekly outlook or monthly outlook, actually, where he talks about, for example, for the US equity indices, the election and pre-election year cycles. So these are big cycles that are recurring and that usually play out the same way. So they have a very high probability, but they are obviously not baked into the seasonal indicator or in these circumstances. So for example, if there's an election year, and you saw that already in his previous classes, then the market sometimes deviates from its normal seasonality, right? And I also did a short class last week. You can watch the recording where I used the Mexican presidential election cycle. So that's every 6 years, all the way back to 2020, to 2000. So almost 24 years. And that is also basically a seasonal trade but it's a much bigger cycle. Yeah. So proof, you mentioned different assets classes will have different seasonality working for it, 5, 10, 15. Would that mean metal class like platinum, silver would have the same? For instance, say 10, or maybe possible that PA might have 5 and silver might have 10. Yeah, I would always backtest it because, I mean, yes, if the markets are correlated, then the seasonality should also be somewhat correlated. So for the metals, probably for the precious metals, right? Probably if 5 works well on gold and silver, then it probably also will work well on platinum and palladium. However, I would at least have a quick glance to kind of verify it, because you might have the odd one out, right? Like Palladium sometimes does its own thing. So same with, you have the 4 indices, but you can see that sometimes the Russell is a bit of the odd man out, right? The Russell sometimes kind of does like its own thing. Everyone rallies and Russell goes sideways or drops or something. So they are highly synchronous, they are highly correlated, but they are never 100% correlated. So that also then implies that the seasonality cannot be 100% correlated. But the likelihood is that it will be very similar, if that makes sense. Okay, perfect. What other questions do you have for me and for the seasonal indicator? Is there something that you would like me to elaborate on, that you would like me to repeat? Something that you struggle to understand or where you're a little bit unsure about? Use this time to ask whatever questions you have. So Matthew, I know we said it works across all markets, but does it tend to work better with finite markets, say over stocks? I wouldn't necessarily say that it works better on market A versus market B. But obviously on an index, it probably is more accurate than on a single stock, just because on the index, how do you say it, an unusual event, so an extreme outlier, is kind of hidden or dampened in its effect because of all the other stocks in the indice. So let's say if we would have looked at, I don't know, the Malaysian airline stock, yeah, and then one plane goes missing and the other one gets shot over the Ukraine or wherever it was. There is no way that the seasonal indicator could have predicted that, right? And said, okay, the stock's probably going to tank because historically this is the day when they lose planes, right? So the indicator would have been very off on that one. If that would have, if let's say Malaysian Airlines would trade in a stock indice, sorry, in an index, then that particular event, its effect on the overall movement of the index would have been somewhat absorbed by everyone else in the index. So if it happened during a time where seasonality was up, the index probably still would have went up. It just wouldn't have went up as much as it did in years where Malaysian didn't lose a plane, if that makes sense. Yeah, so it works very well on stocks, and again we can see that, right? If you just take let's say Apple now, right? You can see that it works well, but let's see on Nvidia. Yeah, on Nvidia now, I mean they had the earnings call here. Again, it actually said it should go up, but did it know that, or could the indicator predict that it would have such a crazy move to the upside? Not really, right? Because again, it doesn't tell you the strength of the move. It just tells you based on the history how the stock behaved. This is how it should behave now in the future. And at the end of the day, businesses also are they're very seasonal, right? Every industry kind of has its seasonal peaks and bottoms. I'm sure Apple also at the end of the day is super seasonal because they always launch the iPhone in the same, right, in the same kind of cycle. What is it now? Every year, and it's always in the same month, right? And then I don't know, every 2 years they have the MacBook or whatever. So there is already September, yeah. So there is already a seasonality baked into Apple. Yeah. Can you cover the radar screen with seasonality? You mean the strategy optimizer? So for the radar screen, I will do this during the kind of the strategy optimizer session. I will club it together with that. Yeah, I think that makes the most sense because it's one way of also kind of automating then the back testing. And because it's the last session in terms of the indicators, it would then be a nice kind of like wrap up for everything, and then we start again with seasonality. Any other questions, guys? Anything else that you would like me to cover when it comes to seasonality and the true seasonal indicator? Matthew, do you always use 30 days forward? Yes, but that's just a personal preference. So you can do 100 or whatever. I just don't like there's so much space on the right, white space. And so for me, 30 days is enough. I want to see like the next kind of month. But sometimes it like if it's a really like a very, very long swing trade, then you might want to do 60 or 90 days that you get that you see a little bit further. Yeah, this is a day. Yeah, so this is on the daily. Yeah, so it projects the next 30 days. Yeah, seasonality I would always do on the daily. And you can see that. So if I change to weekly, I mean, it obviously works, right? But for me, best to see it kind of on the daily. But if you want to, you can use it on a weekly chart. Again, then it might make sense to play around with the settings. What works better then? For me, I prefer to have it on the daily, so I can kind of really see also these small movements, because in the weekly they're then sometimes hidden. So kind of like these speed bumps. It's also then easier to identify the real bottom. Jacob, do you use the seasonality to identify supply and demand zones? What do you mean by that? I'm not quite sure if I understand your question correct. If you could elaborate on that. So we have another request for Tdom. So I would suggest we move that to the next session. Yeah, we can do Tdom then in 2 weeks when we do seasonality again. I will make a note of it. And we can start with that. Yeah, let me just write down. Okay, Jacob. So if I understand your question correctly, you mean, yes, exactly. So that's the whole point, right? So let me go back to where were the treasuries. So if I now only look at supply and demand and seasonality, yeah, if I now for now ignore everything else, I would have a daily zone here, right? Rally based drop. Supply zone, I have another one here, which is no longer fresh in the wider version. And in terms of demand, I would have a zone here, right? And I'm kind of in the middle of nowhere right now. So if I then look at seasonality, seasonality tells me that, so we're here, right? Price should take a small dip, what it seems to be doing right now, right? Today we have a red candle. And then it should rally until kind of here with another dip until here. This is the peak. Yeah. So what I would do then is, okay, because I don't know how price is gonna get to its peak again, right? I don't know if it's just gonna go through the roof or if it's gonna go down and then maybe up and down again and maybe up again, etc. So what I want to do is, the closer we get to this date, I want to then see where's price on the chart right now. So let's assume it's somewhere here. Then I would look, okay, where's the next high quality demand supply zone, and short from there, right? So this is gonna be on the 14th. So let's say on the 13th, we're here with our candle. So I know tomorrow is the seasonal top. Then I would say, okay, I'm gonna place an order here because it's a high quality zone, and I would expect price to maybe get into here. And then from the 14th onwards, to drop, right? Again, I don't know how far, yeah, but if it continues doing like this, then all of this here, right, price will most likely just go through it because there are no quality zones in here. So then I can say, okay, I can be short until the 20th, so a week. This is seasonal bottom. And depending on how strong the drop is in price, I want to get out then on the 20th or before the 20th, and ideally in front of high quality demand, which would be down here, right? So this then kind of also gives you an indication of when to short and where to short. But you see that by just looking at seasonality alone, I wouldn't know where to place my order, right? And same with supply and demand alone. I don't know if these are going to hold, because if, let's say, let me just remove this. If we are here and prices are already in here, and there's still more room to the upside in terms of seasonality, maybe it's then actually this zone where price goes in and then starts to decline. So seasonality could help me then in this saying, okay, well, it's not yet the top, so I don't want to go short here. And then we would later on add obviously the COT, and we would add valuation, and then we get a much more accurate picture of what to do in this situation. Did that answer your question? Perfect. All right, guys, anything else? We have around 10 more minutes. I wrote down already, so on the 18th would be the next time we cover seasonality, that we discuss also TDOM. Yeah. Then I will start with that and maybe talk 20 minutes or so about that. Then we can have another 20 minutes of questions, and then maybe specifically to TDOM, and then maybe have the rest of the session to other questions open. For the DAX. What is it? FDAX? No, is it? Yeah. Yeah. So again, right, if we do back testing here, it should actually, same with the US indices, it should be in decline. However, so far it's still going up. Yeah, so that's why I say it doesn't always have 100% accuracy. And right now you saw that if we look at other fundamentals like valuation on the stocks, most of the stocks are not overvalued. The indices themselves are not overvalued. So then seasonality doesn't really matter, because of course they're not gonna drop if they're not overvalued and they're not in high quality supply. Right, some of the stocks like Apple and Google, they're actually here, they're coming into demand, right? Apple is in demand right now. Google, I think, is in demand. So how are the stocks? How are the indices going to drop if this happens? That's why I said we need to look at all the tools at our disposal and not just focus on one. Seasonality is one of the tools that we look at. Yeah. Say, think about it like if you're a doctor, you just don't rely only on an X-ray, right? You also take a blood test and you talk to the patient and understand about the history. And you might do a swab test. You take maybe then a urine sample. You do X-rays from different angles. Right, you might do a blood count. So you have all these different things, because one of them alone cannot really paint an accurate picture. It can give you a hint, an indication, but you then need further things to kind of validate what is wrong with the patient. And that's what we are also doing here. We don't just rely on just one thing. We combine them together. And each of them has their own specific use case. So seasonality is very good of looking into the future, because everything else isn't. But it's not good at timing, right? Because just because if we just would look at seasonality, we should have actually shorted the DAX here on the 15th of Feb. And that would have been a bad idea. But if we look at our other tools, and we can do that once we are finished with COT and valuation. Tomorrow we are doing valuation, so maybe come back tomorrow with the same question, remind me, and we can have a look then what was the valuation. And most likely valuation did not support a short. So then we have conflicting messages, plus we don't have a zone here, right? Because we're at record highs, I believe. So then we will have two things telling us don't short and only one thing telling us to short. So we probably would be very cautious and might look at something else. Yeah, of course. But again, there's a different thing here, right? Where did it rally from? Right? Was it these zones here? Right? So we'd have to look at this on weekly. So there was a quality zone here. We again have to look at valuation and then seasonality. So we would have three things telling buy, buy, buy. And then of course we would look into entering that trade. But we have a completely different, or we had a completely different scenario here because we didn't have quality supply to short from. We didn't, I mean, we have to look, but we most likely didn't have valuation that supported the short. So we didn't get very clear signals to go. And then there's one question. So when can I ask you a simple question, not regarding seasonality, as I face some issues with my scaling in trade session? Can you show in a quick move how you can hold and drag the chart around with your mouse? You just left click on a candle, so not in the background, but actually on anywhere on a candle. You left click and hold, and you see how the mouse changes to like a little hand, and then you can just drag it around, up, down, left, right, whatever. All right, guys. Any other questions? Otherwise, I say we call it a day. We have 5 minutes left. Thanks so much for joining. Tomorrow at the same time, we do valuation. Like I said, it's a new series. So we also kind of will play it by ear and see what works. Seeing that we have 12 people in the room, the timing seems to be good. If not, then let me know in the comments, please. And yeah, thanks so much for your participation. Please do join me tomorrow for valuation. And then next week, Monday, we will look at the COT and on Tuesday at the strategy optimizer, right? Thank you very much for joining, guys. Have a wonderful evening, and I hope to see you tomorrow. Bye-bye.